Hi all, good evening and welcome. I am Ridul Mishra and on behalf of CareEdge, I welcome you to our today's discussion on real estate, standing tall despite global challenges. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. We have with us Mr. Srinivasa Rao, CFO at My Home Constructions Private Limited, Mr. Ashish Bharadia, VP Business Development and Investor Relations at Nirlon Management Services Private Limited. This session will be moderated by Yogesh Shah, Senior Director at CareEdge Ratings. We will commence the session with the presentation by Amita Yadav, who is the Esteemed Director at CareEdge Ratings, which will be followed by a panel discussion and Q&A session. In case of queries, participants are requested to please key in your panel. We'll be taking your queries during our Q&A session. Now, may I request Amita to begin a presentation, please?
Thank you, Mradul. Good evening and a very warm welcome to the esteemed panelists and the participants attending this webinar today. I, Amita Yadav, will now present CARE's view on the real estate sector with focus on residential and office leasing segments. In this presentation, we will cover the key messages of residential and office leasing segment, macroeconomic backdrop, pan-India trends in the segments with focus on top 6 cities, credit rating perspective, aggregate performance of top domestic players, and CARE's outlook for the segments. Let us begin with the key messages. For the residential segment, strong consumer sentiments are expected to drive and keep inventory overhang close to 1 year. Property prices are on upward trajectory. Owing to robust collection, the top developers continue to deleverage their balance sheet. Now coming to office leasing. Despite global challenges, the leasing activities are expected to be closer to 2022 levels, with IT-driven cities witnessing significant addition in office spaces. The hybrid model is likely to keep the vacancy level range bound, and the rentals are expected to move up. India's real estate sector has shown signs of sustained growth, closely tied to the overall economic development. The country's macroeconomic situation appears favorable, with GDP growth surpassing expectation at 7.2% for FY23 and inflation being on a downward trajectory. Bank credit, including housing loans and commercial real estate, has seen significant growth, indicating confidence in the real estate segment. While there are lingering concerns about the economy, the risk of global economic slowdown and geopolitical escalation impacting Indian corporates and the overall economy are currently low. Hence, CareEdge maintains confidence in strong economic growth of 6.5% for 23-24, driven by domestic consumption, government investments, and private expenditure. Furthermore, government initiatives like Smart City Mission and Pradhan Mantri Awas Yojana, along with strong focus on infrastructure development, are expected to benefit the real estate sector. Now moving on to the performance of residential real estate. Despite the challenges posed by the COVID-19 pandemic, the real estate segment has displayed remarkable resilience and stability. Contrary to initial expectation of a prolonged recovery, the sector quickly regained momentum and witnessed a strong rebound. With the easing of COVID-19, improved consumer confidence, developer sales schemes, and ongoing government support, sales in the year 2022 reached the highest level in the past decade. Developers have also responded promptly to the growing demand by launching new projects, resulting in the highest number of project launches in the past 8 years. CareEdge expects both sales and launches to be above 4.5 lakh units for 2023 and inventory overhang to remain close to 1 year. The growth momentum is projected to persist due to robust demand. Though the Indian real estate is emerging as a preferred investment avenue amidst market volatility, the demand primarily stems from end users, as the significance of owning a home has become more vital now. Moreover, there has been a shift in consumer preference towards larger residential units with good amenities, Consequently, the premium segment share in overall transactions is expected to increase. Alongside the evolving preference for larger size houses, there is also a growing inclination towards established and renowned developers. If we look at the left two bars of the chart, it shows that more than 70% of bookings are done at nascent stage of constructions, while for medium and small players, majority of the bookings are done at post-slab and at completion stage. This is majorly driven by the quality construction and timely delivery of projects by these developers. As a result, these developers are capturing a significant portion of the sales transactions, accounting for over 50% of the total transactions in 2022. Due to the strong sales momentum, decreased inventory overhang, preference for larger size units, increase in input cost, and almost negligible growth in prices in the past, the rise in property prices was inevitable in 22. Prices rose by approximately 8% nationwide, with the NCR and Hyderabad experiencing the highest growth. However, despite the increase in prices, buyer sentiment has remained unaffected so far. Based on the expectation of a sustained sales momentum, CareEdge predicts that rates will continue to rise between 4 to 7% in 2023. Now moving on to the office leasing segment. With the increase in PE investments and strong growth in the IT sector, 2019 was a milestone year wherein the commercial office leasing market reached a record high with over 50 million square feet of completion and absorption. However, the COVID-19 pandemic disrupted the growth in 2020, resulting in a significant decline of approximately 46% in overall absorptions. The market faced further challenges with the second wave in 2021. Nevertheless, this segment experienced a remarkable recovery in 2022, driven by return to office and flex and managed working spaces, especially in IT and BFSI sectors. Despite global uncertainties, CareEdge expects leasing activities to remain close to 2022 levels as India continues to be an important player in global talent and business growth strategies. Vacancy rates are estimated to be around 16 to 17% for 23. The rentals in all cities are displaying an upward trend. The significant factors contributing to the increase in rentals include strong leasing momentum, heightened occupier confidence, and the supply of new office spaces at higher rates. Pune and Bengaluru particularly led the year-on-year growth chart in 2022. CareEdge estimates that the rental will continue to rise due to rising interest rate, elevated cost, investment in sustainable buildings, and rental escalations. Let us now analyze the performance of top 6 cities of India. MMR witnessed the lowest inventory overhang and vacancy rates in the past 5 years. Strong consumer demand continues to drive residential sales, with the eastern suburbs emerging as a preferred market. The office market has also experienced significant year-on-year growth in transactions, led by the BFSI sector, with majority of the deals taking place in western suburbs and Navi Mumbai micro markets. Going ahead, the growth in Mumbai is anticipated to be driven by healthy demand and substantial infrastructure development. Prominent endeavors encompass Navi Mumbai International Airport and Mumbai Coastal Road Project. Furthermore, a range of road and metro projects are underway, which are likely to keep the sales traction healthy in the adjacent suburbs. In 2022, the residential market in the National Capital Region saw strong demand, leading to a significant decline in inventory overhang from 41 months in 2020 to 16 months in 2022. The office space leasing market also experienced a surge in transactions. Although vacancy levels remained relatively high, The demand for traditional and flexible workspaces is expected to drive further growth in the NCR. Gurugram is rapidly emerging as a prominent location in NCR. The micro market is well connected to other regions of NCR, and the ongoing metro project linking various other areas of NCR will further enhance its connectivity. The project is anticipated to have a substantial impact on the real estate dynamics. Bengaluru remained the top performer in office leasing, accounting for 1/4 of total leasing transactions in 2022. IT, global capability centers, and startup ecosystems were the demand drivers. Also, co-working spaces flourish in the outer ring road area. Residential sales in the city also reached a 5-year high. The northern suburbs were the most popular micro market, driven by proximity to tech parks and employment clusters. Talking about the infrastructure development in the city, ongoing projects such as the metro rail lines, peripheral ring road project, and the satellite town road project are likely to augur well for the real estate sector. Over the years, Hyderabad has grown as an attractive destination for establishing large IT parks, owing to the availability of ample space and excellent infrastructure. This is also evident from Hyderabad standing second to Bengaluru in terms of Indian office leasing, the IT industry and pharmaceutical sectors being the key drivers. In terms of residential, Hyderabad market has witnessed highest growth in property prices since 2018. This is attributable to healthy demand from investors and end users. Talking about the micro markets, the peripheral west region remained in high demand, driven by proximity to the city's commercial core. The city is also experiencing a significant boost in its infrastructure, with extensive road development projects, and thus the market fundamentals for real estate will continue to remain strong. Pune is an alluring real estate investment hub in the state of Maharashtra due to its close proximity to Mumbai. Pune's residential market witnessed a remarkable YoY growth, reaching the highest sales figure in a decade. As a result, the city had the lowest month to sell among the top 6 cities. On micro market front, East and West markets were the primary contributors to the sales volume, with presence of IT parks and large employment hubs in the vicinity. In the office space segment, managed office spaces gained popularity among occupiers, driving the demand. Kharadi and Hinjawadi were the prominent prime locations for office leasing transactions. Infrastructure development currently ongoing in the city includes the Pune Ring Road project, Mula Mota Rejuvenation project, and Metro project. These projects are likely to benefit the micro markets including Hinjawadi, Chakan, Kharadi, CBD, and more. Going ahead, Pune's real estate sector is expected to maintain a positive outlook with low inventory overhang and a balanced vacancy rate. Chennai is gradually becoming the destination for startups driven by the emergence of NH4, large-sized SEZs, and IT parks. The city experienced the highest transaction volume in the office leasing segment in the past decade. Despite challenges, the market demonstrated resilience and benefited from a diverse tenant base led by the IT industry. The BFSI sector also contributed significantly with growing demand from startups and healthcare occupiers. Chennai's residential market also achieved a breakthrough in 2022 with over 17,000 units sold. The growth was driven by improved consumer sentiment, with sales primarily concentrated in suburban and peripheral micro markets. The ongoing infrastructure projects like major state road upgrades, the Uppur Ultra Mega Power Plant project, the Madurai Thoothukudi Industrial Corridor, and upcoming metro rail line projects are likely to benefit the real estate sector of the city. Going ahead, Chennai's real estate market is expected to maintain a balanced supply and demand dynamic, resulting in stable vacancy levels. Having looked at the performance and trends in the residential and office space leasing segment, let us ponder upon the emerging trends and challenges of the segment. In the residential segment, we are witnessing a noticeable change in consumer preference with a growing inclination towards larger homes and well-established developers. Additionally, energy efficient and eco-friendly homes are gaining importance, highlighting the rise of ESG in real estate. Challenges include potential impact from rising interest rates and inflation, as well as volatility in input cost. In the office leasing segment, institutional developers and sustainable buildings are gaining preference due to hybrid work models and flexible workplaces. The office leasing segment remains an attractive asset class for private equity investors. Also, the increasing presence of real estate investment trust in the Indian commercial leasing space is noteworthy. Key challenges that the segment is facing include global headwinds and concerns about a potential recession, which resulted in delayed leasing activities in Q1 of calendar year 2023. The delayed enactment of the Development of Economic and Social Harmony Bill has affected leasing in SEZ parks. Now let us discuss the credit rating perspective of the real estate sector. The slide shows broadly the rating dispersion of companies rated by CARE as on March 31st, 2023. 38% of total cases are lease rental discounting. The segment is skewed towards investment grade rating, referred to as IG. 63% of the portfolio is IG, that is BBB minus and above rated, and the major contributor to IG ratings are LRD, given their stable cash flow and built-in structures. Companies in higher category rating represent the organized sector of the industry, with strong parentage, established brand image, demonstrated group support, and strong corporate governance. The operations of these entities are professionally managed, they have product diversification like residential and commercial leasing, and are less leveraged. The credit ratio is the ratio of upgrade to downgrade for a specified period. As seen from the chart here, the credit ratio has improved from below unity in the past years to above 3x. This implies more upgrades than downgrades, unlike the yesteryears, which was largely attributed to the gradual economy unlocking process and robust performance of developers. There were only 5% downgrades in the portfolio during FY23, which were majorly in the low rating band. The downgrade factored in the slowdown in operational performance, unenvisaged debt addition impacting leverage of the company, drop in occupancy percentage, and delay in project execution or leasing. The key factors which contributed towards upgrade were improvement in execution or booking status, reflecting improvement in key ratios such as cash coverage ratio, committed receivable coverage ratio, leverage, improvement in occupancy or tie-up of leases at higher than expected rentals, and loan to value. Now let's examine the aggregate performance of top domestic players in residential segment. As we have seen in our earlier slides, that there is a growing inclination towards reputable and established developers, and this is also evident from growing sales and collection of top 5 listed players as presented in the left chart. Furthermore, FY23 being a milestone year for the real estate, the collective pre-sales of top 5 players have surpassed rupees 500 billion. Talking about the leverage position, these developers have raised approximately rupees 20,000 crore of funds in the past 5 years. Such fundraising, coupled with healthy collections, have reduced their dependency on external debt for funding projects. This is evident from the significant decline in gross debt levels, which has decreased from a level of rupees 40,000 crore in FY18 to close to rupees 26,000 crore in FY23. On the other hand, owing to robust operational performance, collections are on upward trajectory, and hence the ratio of debt to collection has fallen below unity. Going forward, CareEdge expects the dependence on external debt to remain low for future expansion, given the healthy pipeline of customer collection induced by recent sales momentum, and thus the debt to collection ratio will continue to remain below unity. Now talking about real estate investment trust, referred to as REITs. REITs offer investors a less risky investment option compared to under construction properties. The USA leads the global REIT market, while Japan and Singapore dominate the Asia Pacific region. The introduction of REITs in India occurred in 2019 with the debut of Embassy Business, followed by Mindspace and Brookfield REIT in 2020, and subsequently Nexus REIT in 2023, which is into retail. All the REITs in India are listed on domestic exchanges. In India, office REITs have grown significantly, with operational stock increasing by 26% from 2020 to 2022. Moreover, the share of REITs in the total stock of the top 6 cities in India has remained consistently over 9%. In terms of the financial performance, the REITs are less leveraged with net debt to gross asset value of only 26% and comfortable net debt to EBITDA of 4.7x for FY23. Additionally, due to the stringent regulations imposed by SEBI, REITs have a strong structure that enables them to secure the lowest interest rates on external debt within the industry. The availability of abundant Grade A office stock, which are REIT-worthy, offers numerous opportunities for REIT to expand their footprint in India's commercial real estate sector. The expansion of REITs in India will promote transparency and governance, attracting global investor interest. Now let's discuss the outlook for the segments. Starting with the residential segment, it is expected to maintain a moderately positive outlook due to the continuous and robust demand. For the commercial office segment, the outlook remains stable, driven by the return to office and increasing popularity of flexible working spaces. However, it is important to monitor global headwinds and the impact on income levels, as these factors may present some challenges. With this, I conclude my presentation. Thank you everyone for patient listening. Over to you, Mradul.
Thank you, Amita. Attendees are requested to please key in the questions which we'll be taking up during the Q&A session. Now, may I invite Mr. Yogesh Shah to take over the session, please. Yogesh is the Senior Director and Head of MCG Division at CareRatings Limited. He has a total experience of 22 years, of which he has been associated with CareEdge for over 20 years in 2 separate stints, one with General Ratings Division and the other as part of MCG Division. Yogesh has played a key role in development of credit rating model at CareRatings. He is the CA and MBA Finance by qualification. Over to you, Yogesh.
Thank you, Mradul. Thanks, Amita, for the wonderful presentation. So I would first like to grasp up the participants that we have with us today some of the best industry experts to discuss the sector in detail and provide us their views on how the sector looks like. So let me first introduce our esteemed panelist. Our first panelist today is Mr. Srinivasa Rao. So if you are able to see on the screen, he's a chartered accountant and currently serving as a CFO at My Home Constructions Private Limited. It's a reputable construction company specializing in residential as well as the commercial complexes in Hyderabad. My Home Group is a renowned group as one of the top real estate groups in Telangana as well as the Andhra Pradesh. So in this professional journey spanning over 3 decades, he now plays a vital role in driving the strategic decision-making process of the group as well. Thank you, Mr. Rao, for joining us. So I now introduce our second panelist, Mr. Ashish Bharadia. Mr. Ashish is also a chartered accountant and a graduate from Mumbai University and has completed 2 executive courses on sustainable cities and affordable housing from Erasmus University, Rotterdam. He has over 17 years of experience across the wide spectrum of functions in the real estate sector, and is currently leading business development as well as the industrial relations functions at Nirlon Management Services. Prior to NMS, he was associated with CareEdge Group as well as a consultancy firm where he led the transactions as well as a number of consulting assignments. So, warm welcome to Mr. Ashish.
Thank you.
So now we can start the panel discussion. My first question would be to Mr. Rao. Mr. Rao, as we have seen in the presentation, the real estate, especially the residential market, that is consistently experiencing upward trend in last 2 years. And I would like to hear from your perspective, given your association with one of the largest developers in Hyderabad, which is boasting nearly 30 million square feet under construction. So what are your insights on the market's trajectory in the next 3 years?
Okay, thank you, Yogesh. And to start with, I appreciate Amita for the wonderful presentation that she has brought out several facts with regard to the real estate industry for the benefit of several participants. And with regard to the residential real estate, there is no new news that anybody can give, because for the last 3.5 years, everybody had a mixed feelings on the real estate initially, and thereafter they thought real estate also recovering from the COVID. And now at this current juncture, real estate is the industry which is leading the pace in the entire country. So how we have to see these growth prospects for this particular industry, and why there is a change in the individual perspective for owning a house.
Yes.
So it is already noted and observed, and especially from the Hyderabad and our experience from our own group, I can share few facts where we feel why people are shifting to the larger houses. So now, at one point of time, people were clear that even to live a house, a 2-bedroom apartment is good enough. But now, for several reasons, one is only affordability. That's it. It's only a small part of it. And second, it has become a necessity. People have to eventually be ready themselves, like an insurance or whatever it is, to face upcoming challenges like COVID kind of situations, to have sufficient space. And third, jokingly, some of the people say, how long we live, we don't know. At least let us live in a luxury space. So that is the thing. And now with the technology that got emerged, even the top class real estate developers are also coming up with several amenities. Say, if I have to take example of one of our own projects, a 3-star hotel like a clubhouse is within the complex, where you will have banquet halls, provision stores, various other facilities. A sports village is accommodated within the complex. Say in our 20 acres of complex, if we take it, maybe you have all sports to learn up to national games. So these sort of the amenities and all other things are attracting the people to own an apartment in a gated community where you have good amenities and various other things. So this is making the people to get attracted to buy their spacious new house in a gated community where you have all the amenities. What is supporting to do this is basically necessity is the only smaller thing. As the GDP also is growing, the disposable income levels are also growing. People are able to afford this kind of the little costly assets comparatively earlier. And here, what we see is important shift is people, instead of using their own disposable incomes to buy the new house, many people are shifting from their old house to the new house. So the mix and match of apartments is changing. Say earlier at one point of time, NRIs used to buy luxury houses, or businessmen used to buy the luxury houses. But now the shift is coming from the middle income level people also. Probably they must have bought 200 square yards flat or 300 square yards flats some time ago. And they are able to dispose it off, and they are able to afford for the bigger house. And at the same time, someone who has about 10 years back or 12 years back, maybe accommodated themselves into a 2-bedroom house. Now they wanted to go to the 3-bedroom or 4-bedroom house. Likewise, there is a huge shift in the investor perspective or customer perspective for owning of a residential apartment. And with the GDP increase and availability of the disposable income in the hands of the people, their initial needs to own a bike, to own a car, to own a luxury car, to go to the foreign trip, and all other getting already experienced, and they have become the low-cost items. Now, in order to live in and present, secure their money, and to present to the people also, even this also has become one of the main criteria for the people to go for the residential house. We see these kind of the things with a mixed thing, not only in Hyderabad, in almost all top 8 cities of the country. And very recently, someone has presented to me, not only the 8 cities of the country, even 23 Tier 2 cities also have been experiencing the increase in residential sales. So that means overall, the perspective or the view of the individual person, whoever can afford to buy a residential apartment, is not postponing their purchase. He is immediately clocking. That is the reason we have seen in the presentation also. Almost 68% of the houses are got sold when it is in the initial stage. So that means this momentum is across the country, and people wants to have good luxury house. And this trend, I feel it started only 2 to 3 years back, and at least going to continue as your second phase of the question. Another 3 to 4 years is what we continue to see.
That's
Why
great
this is
clear. That's great clear. Sir,
that is the reason why it is continued to.
Yeah, sir. So you have given us the feedback, like what are the growth drivers, especially for the luxury segment as well as the mid segment. But if we talk about say the affordable segment, wherein the housing is witnessing a bit of headwinds, especially if we talk about there is a rising cost and the interest rate is also increasing, so it is likely to impact the affordable segment demand. So what is your view on that on affordable segment?
Yogesh, here probably I may disappoint some of the people with regard to the affordability segment. Our personal experience is the word affordability has not been defined anywhere. First of all, to understand whether it is per square foot and all other things is only for the purpose of taxation. For the income tax, the number of square foot is different, and for the GST, in order to get 1% is 40 lakhs or something other than. So whether we can call it as an affordability or not, I don't want to touch upon that. But if someone clearly understands only 40 lakhs is the judgment for the affordability, in metros or at least top 8 cities of the country, which we generally analyze, where can we get an apartment at 40 lakhs? Or in at affordable, even if it is 50 lakhs, 60 lakhs. Because cost of construction and it is increasing from 3,000, 3,200 about 4-5 years ago to the 4,200 to 4,500 rupees per square foot.
Correct.
And even it doesn't meet even the construction cost and minimum margin. And where from we have to get from the land. And if the affordable segment should be within the city, because those people may have to have more of the public transport or a two-wheeler transport rather than the car and various other things. A metro connectivity, bus connectivity, scooter mobility or something other, if it is possible and feasible, in those locations, the affordable segment flourishes a lot. But now within the city, since it is not possible and we can provide only at the suburbs, commuting has become a big difficult for those people. So I feel in actually affordability segment is still there even in Hyderabad or many other places, but it is not growing in my personal perspective. But nevertheless, it is started growing in the Tier 2, as I said, and probably we can see affordability segment goes to the next levels in next 2 to 3 years in the Tier 2, and Tier 1 probably, though I can't say it is muted, but it will be quite low penetration that can be witnessed in coming years.
Got it. Moving to the office leasing sector, Mr. Ashish, considering your affiliation with the prominent leasing company, We seek your valuable insight, especially the prospective landscape for leasing activities, vacancy rates, how it is moving, and the rental trends. So in the year to come.
Thank you, Yogesh. So let's go. So typically, if let's say office leasing or absorption, essentially it's an evolving scenario if we look at this year as compared to last year and going forward. So to throw some light, last year, 22, there was a huge amount of absorption. Some of it could be attributed to the post-COVID latent demand that kind of came about. Going forward, I think the inquiries have been good, but at the same time, people, the licensees or occupants, they have become a little more cautious, and while we can say the decision making could have slowed down a little bit because of that, and most of them are expecting or looking for at least a lot more flexibility. So that's where, in terms of the absorption clientele comes, if we could see co-working has been able to absorb a lot more space compared to what they used to do historically. At the same time, the reason they are being able to do it is because they are seeing a fair bit of traction on the other side, where they are able to give out space to their clients. Again, a lot of these clients would probably be the same people who would earlier take the space themselves, fit it out themselves, enter into long-term leases. And now they are, for whatever is their flex demand, so to speak, they are preferring a co-working space because that gives them a lot of flexibility to ramp up and down as they need. One thing which is, in some sense, effect of consequence of this is most of these large players seem to have a certain quantum of captive space, which they continue to have on their own. And then for the ramp up, ramp down, they're trying to use the co-working providers so that they can, because it gives them the flexibility to go up and down very, very quickly without a lot of investments. In terms of occupant category, I think with the focus that the government of India has on Make in India and manufacturing, we expect to see a lot more demand diversity. Historically, IT, ITS used to be the major demand drivers. Going forward, with the focus on these segments, I think co-working, as we have observed recently, R&D centers for pharma and other high-end applications, even media and entertainment, with an exponential growth in content that is being created every day with the number of proliferation of OTT platforms. So all of these people will take a lot more space, a lot more absorption, and hopefully we'll be able to see a lot more diversity in the occupant category absorption going forward. Within the country, I think different cities would probably perform differently. Bengaluru has always been the largest city in terms of space absorption and supply, and will continue to be so. Cities like Mumbai generally have lesser supply coming up in the immediate future, whereas cities like Hyderabad have a lot more supply coming a lot quicker. A lot of it is already up. So while that may have an impact on the rentals and vacancies, at the same time, it also is a positive from a occupier perspective who need a large plate in a very short period of time. So Hyderabad has a lot of supply, which may have some impact on vacancy. But at the same time, if somebody needs that kind of space, that's the only place you'll be able to kind of, get such plates within the very short time frame. Otherwise, all cities would continue. NCR, as we have seen in your presentation, has a reasonably high vacancy, which should impact the rentals. Another aspect that you'd probably see more and more going forward, maybe on a comparatively longer term, is there will be some kind of a K-shaped recovery or K-shaped growth where people would prefer to go. So a grade B occupier would prefer to go in a grade A building. A grade A occupier would want to move to a grade A plus building or asset. And therefore, a lot of these assets which are able to meet the specs will probably be occupied much quicker than the older assets which may not be able to meet these requirements and therefore will need some amount of refurb or retrofitting to be able to be upgraded.
Got it. But if we specifically talk about the office market, and because IT sector nearly contributes 35 to 40% in the total occupancy, in last 5-6 months we are able to see some sort of slowdown because of the overall slowdown in the world economy in the IT sector. So how is the trend so far as the inquiries are concerned or the leasing activity in this segment?
So let me split it into two parts. First, IT has always been the single largest category, so to speak, in the country as far as absorption goes, and it'll continue to be so. As far as the slowdown in the Western world goes, historically what has been observed is whenever there is a slowdown over there, or they are, and therefore they are reducing jobs or trying to reduce cost, eventually they end up moving those jobs to countries like India. So even during the recession, the financial recession, etc., jobs have typically moved to places like India, and therefore the absorption has actually increased whenever as a consequence of slowdown in their home markets.
Okay, so you are taking it positively, in fact. Fine. Mr. Rao, as we have seen recently in the PPT, that there is a good amount of inclination towards the large and reputed builders while purchasing under construction properties. So in this context, how should homegrown developers compete with the national and the institutional players? Because the small players do face challenges. What is your view and how to basically take that thing into consideration in the overall scenario?
What I feel, always you will have the premium, ultra premium or middle category everywhere, in every section. And with regard to the inflationary costs that are continuously going up with the increase in the commodity prices, labor costs, and various other things. But today, what we have been observing is cost is not just increasing because of the inflation alone. So if I have to give some detail about it, even the individual perspective, people are looking for higher spec houses, higher specifications. Say, for example, instead of going normal tiles, people are looking for glazed tiles, polished tiles, marble flooring. Automatically, it increases the cost. It is not linked to the inflation. And when we have to have a sanitary fittings, at one point of time, whatever the sanitary fittings which we have seen, those brands are not appearing now. People are looking for Villeroy's Bosch and those kind of things people are going for. When electrical fittings, all other things are going up, and people were not looking for the provision for the air conditioning earlier. People are looking for the provision for the air conditioning. Likewise, if I have to keep on talking at every section, so people are looking for a branded segment material wherever it is appearing, or the next level where they wanted to showcase that particular thing, or where they feel that it long lasts. So apart from the inflationary costs in the labor and commodity, specification costs also added. This is not being appreciated much sometimes, and people are thinking that the cost of construction has gone up per se. If we divide both, it appears that the inflationary cost and all other things is to a certain extent, and balance is something else. This is one side of the story. Second side of the story, when it comes to the developers also, not only these specifications of individual flats, overall township or overall complex costs. Say, for example, when you have to have the lifts. Earlier, when you have to have the lifts of 8 people, 10 people, 12 people, 14 people, only for 10 story to 14 story to 20 story. But today we are talking about, in Hyderabad especially, 30 storied and above, 40 storied, 45 storied, 47 storied. And in the last 1 year, more than a dozen projects got launched in Hyderabad, which are above 40 storied. So once you have these kind of the things, fire norms comes into the picture, lifts of the high-speed lifts comes into the picture, and whatever the open area which you have to keep, and amenities what we have to have, these also will come into the picture. So all this put together is increasing the cost, and it's not only the steel or cement cost or any other commodities. Maybe very recently we were making one small analysis about 15 years back, and today, if at all, we have to see 25 to 35% of the cost of construction, forget about the land, only pure cost of constructions might be attributed to the steel and cement. Today, it is surprising, even 10 to 15% only is towards the steel and cement. So because of this particular reason, the incremental cost is not only the basic commodities and labor, and because of various other reasons.
So your message is basically the homegrown developers basically need to be more towards the customer centric, and whatever is the service delivery as well as the service quality that they need, they also need to provide, so that they can also get the momentum, especially the collections and everything is booking is concerned.
So this, I feel I don't say only large developers have advantage, and now the advantage is too for the people who can adhere to the commitments. Say, fly-by-night operators may suffer, or people who do not have the reasonably good capital may suffer. But otherwise, say, if at all, if I have to talk about the Hyderabad, only 25% to 30% of the houses are sold by the top 10 builders. So rest all other things by the small and medium term. Maybe this ratio is different, core Mumbai or core Delhi or core Bangalore. But whatever it is, even they are also sustaining. And with regard to when it comes to the rates, as I was already explaining to you, because of the specs, high rise and various other things, when these costs are very high, mid-segment where you have 5-storied, 9-storied, 14-storied, 18-storied, these people are able to give at least 20 to 30% price difference from the larger builders. And if at all, if the medium range builders are able to deliver and give the reasonable quality, I don't think that they are going to suffer in the system as such. But here, delivery, adherence to the specification, quality, and various other things, if they are able to put it, as far as the residential is concerned, it is not, though people may put the confidence on the large builders or branded builders, if the second level builders or mid-category builders, if they are able to present the delivery, even they also have the equal room for the growing. And in not only in Hyderabad, other places also we have seen, they also have the equally good traction. That is what we have seen in your presentation of the rating improvements also. Maybe even triple B category also, there are several improvements.
Yeah.
So that is the reason why I don't differentiate when it comes to the growth only. It is happening to the super large or large or whatever it is happening across. And people who do not have the financial discipline are not adhering to the terms and conditions, what they have agreed with the customers, probably they are suffering. But per se, everybody has equal foot, is my opinion.
Right. Sir, referring back to our presentation, Mr. Ashish, if we see that there are abundant opportunities for the expansion of office REITs. So looking ahead, do you believe that the REITs will diversify beyond the office sector to include the segments such as retail or the hospitality? What is your view on that?
So REITs are like a fairly evolved product if we look at the developed markets, where you even have residential REITs. And I think we will also go the same path of evolution. We have 3 office REITs. Obviously, now it's become more or less a stable thing. We have a retail REIT which got launched recently, the Nexus REIT. And definitely going forward, the investment category, the segment itself will evolve. Stuff like that. And the whole discussion around it and the regulation around it will keep evolving. In terms of the categories, now again, these is not definitely real estate, but warehousing and data centers would probably be the next 2 big target segments for a REIT or InvIT, whichever way you classify. Logic being, there's a lot of institutional money that has been invested in these 2 segments. And as you know, for institutional money, they need to have an exit at some point of time and return money to their investors. So there's a lot of money that is coming into office space, the institutional money. If you see, most of the grade A space is already owned by the top 4 or 5 institutional investors in the country. Warehousing, data centers, given data center more so because it's so capital intensive, will have a lot more. Predominantly all the investments are either captives or the big institutional guys. So that would be one big segment or target, which would be a lot more amenable to REITs going forward. We should hopefully see a lot more action on the retail side. But if you see on the retail side, the ownership of assets are largely fairly concentrated amongst a few players. If we look at pan-India assets, and REITs by definition would require diversification, or diversification is one of the major USPs of a REIT. So if you look at the retail side, there are a few large owners of retail assets in the country. Hospitality, hotels, maybe given the cyclicity of the business, we may see REITs coming a little later than the other segments. Residential REITs, by the very nature of the yields that they generate, I don't know if how long it will take to come, because yields are like in 2, 3, 4% range.
Correct.
And it's dominated by individual investors or HNI investors. Having said that, apart from REIT, there is another thing which is happening, which is fractionalization or tokenization, whatever the fancy word you want to use for it, where instead of having a huge basket of millions of square feet, what people are trying to do is splice up a single asset or a small group of assets, like 1 office or 2 offices, etc., and make the investment bite much smaller. This area will also, to my mind, get a lot more regulated by SEBI, and in some sense will come under the AIF or one of these overarching regulatory environments, which is a good thing as against being completely unregulated.
Got it.
REITs will see some of these ancillary type of products also, like the fractionals and tokenization, so to speak.
Okay. Mr. Rao, if you can throw some light, especially government has taken a lot of steps like introduction of RERA, IBC to protect the interest of the buyers, and is now focusing on resolving the issue of the stalled project as well. So as a developer, like what challenges do you foresee in acquiring and executing stalled projects?
Okay, good question. With regard to not only the stalled projects, even getting the finance for the developers, maybe large-scale developers, because of their ability to raise the money, maybe they have the wherewithal. But in order to buy the land or in order to acquire the companies where it has got stuck in initially, the funding through the banking channels have become very difficult. So the easing mechanism and all other things to a certain extent, though it is there through the IBC and all, the funding cost, especially for the stalled projects and for the litigant projects, is very, very high. Second, real estate, since the sentiment is attached with the practical individuals, maybe once a project is named with that, there is some litigation or something or the other, even buyers also may not come forward so quickly unless and until they are able to see the momentum in the project very clearly. So in such a circumstance, unless and until the rules and regulations of the banking to support these kind of the stalled projects or to support the developers is eased to a certain extent, we will not be in a position to get the I don't call it as a cheap money, as a reasonable money to make that particular asset good. But however, at particular inflection point, automatically these stalled projects also comes to the limelight and started doing pretty well. And that is the reason why in your presentation and in the data also, in the last 5 years, the lowest number of inventory levels, why it is coming down is at one particular price point, even stalled projects also are seeing the day of the light. The only challenge that what we are feeling is, even after the RERA also has become another statutory compliances for the builders. To a certain extent, it is helpful for the customers, absolutely, there is no doubt. This has not changed the funding options to the builders. So had it been changed to a certain extent, funding options to builders, say for example, like a manufacturing company or any other company, based on the inventory levels, if you are able to get some working capital loans or something other at an affordable cost, automatically it reduces the cost of operations. Such kind of the things will not be there. And though you have an IBC and various other things, even income tax or something for the demerger of many big players or many companies, even small or big, they will have 2-3 projects in one particular company. Let us say, if you have to demerge one particular project where they are unable to perform as per the terms and conditions of the banks or something other there should be an easy mechanism to demerge that particular project, and the bankers can take the control of that and can hand over. So such kind of the mechanism is not in place. With that particular thing, if a company has 2 good projects and 1 bad project, sometimes all becoming bad, a rotten apple or banana making the entire basket as rotten. So instead, if at all, if there are certain flexibilities given under the Companies Act, in order to have a project-wise demerger, each and every project should be considered as an undertaking. And they should facilitate demerge. And this option, if it is given to the bankers, instead of touching the company, they can demerge that particular project and can hand over to somebody. So such kind of the flexibilities have to be given. So once these are also improved, like because of the RERA, working capital loans extension, and because of the IBC and various other things, and demerging of the project, are enabling the bankers to take the control of one of the project, if at all, if it is not doing well, And these are some of the things which people do expect, apart from clarity on certain GST issues and various other things, especially in the JDAs and commercial real estate. If at all, if there is a easing on this particular thing, overall cost of operations can come down and can help the people.
Yes, yes. So I have some more questions to the panelists, but I think we also have a good number of Q&A inputs from many other participants. So probably we can move to those questions. One question is from Janki Krishnan. Probably Mr. Ashish, you can address this thing. This is regarding the office vacancy levels, which we have seen in 2023, which is likely to be continuing at 16 or 17%. So is not the supply of office space is lagging the absorption, or what is your view on your take on that?
Sorry, your question is supply is lagging the absorption?
Yeah. So because we are talking about 16 to 70% vacancy levels in 23 as well, which has been there in 22.
So in fact, then it should be other way around. Like, okay, if we just saw the numbers. So calendar 22, the supply and absorption was more or less pretty much.
Yeah.
Going forward, and in general, you'll always see supply to be a little bit higher than the absorption. And then what happens is, I'm saying the net absorption. So yeah, I think in 23, most likely the supply will be higher than the net absorption, which will have some pressure on the vacancies. But
so far as the vacancies are concerned, it's in the office space, a good amount of inventory is also there for in the SEZ segment, probably, which is also yet to take precedence, especially because government is taking some steps to improve that, right?
So that's another challenge. If you see SEZ, because now the benefits have more or less over for the occupiers. So there's no more incentive for those guys to continue occupying SEZ space. At the same time, they have to follow the restrictions, etc. From a developer's point of view, again, they have only two choices. Either you have to let it be vacant, or you have to denotify by paying whatever premiums or back taxes, etc. Now, the thing is, to make the process simpler, so a denotification is possible even under the old current existing laws, but it's a fairly onerous process. So the Desh Bill essentially was trying to make the process easier, simpler, so that the space can be denotified within a reasonable time frame. They can pay whatever needs to be paid to get it done, and it can be occupied as a normal non-SEZ space. So once that gets done, I think we should see a lot more of the denotification happening.
Got it. Mr. Rao, probably you can attend this question that is coming from K.A. Aswin. Especially it is talking about Hyderabad market. So what is the outlook and the challenges for funding so far as the under construction grade A commercial projects is concerned?
If I have to put one single line answer, it is not that easy. Say, I don't want to beat around the bush. As far as the current position is concerned, unless and until the developer has alternative avenues for meeting of the commitments that they can give for the loan, based on the standalone project receivables, meeting is very difficult unless and until they have previous history or alternative sources or various other things. That is a big deterrent, but that is the fact.
Correct. In fact, the question is also with respect whether the real estate developers are enough focusing enough for developing a grade S office space because the demand seems to be overshooting supply. Is it the correct judgment?
No. It is not the case. Say, here, as Ashish has already mentioned, even the last year, 2022, even the absorption levels as well as the new supply is almost equivalent. So the real estate developers, whoever are there in the commercial real estate, have to have their own skin in the game in a big way comparatively earlier. So as long as they are able to fund it through their capital or long-term capital or alternative receipts that what they have, they can continue to be in the commercial real estate because in next 2 years or 3 years or 4 years, it is going to be there. It is not that we say post-COVID, residential has recovered little faster. It doesn't mean that the commercial is completely out of the picture. And commercial, whatever the leasing overall country level has happened in 22 is almost similar to 2019, and we always cannot compare with the best year in the last 10 years. No, just before that 2018, if you compare, in 22, if you compare, even commercial real estate is doing extremely good. And we cannot have a benchmark of a best year and it has to be beaten every year. That sometimes may be practical and may not be practical. First. Second, the gestation period of completion of a project also differs. Sometimes it takes 2.5 years, depending upon the number of floors. Sometimes it takes about 4.5 years. In some of the commercial projects which are built in a phased manner might take even 5 to 6 years also. So that is the reason why year over year comparison also sometimes is misleading. And now, unfortunately, everybody has become the quarterly CFOs, and we are seeing the quarterly data, which is not correct, especially in the real estate and more so in the commercial real estate. And maybe it has come in your presentation also papers. Even Western markets or the VCs or PEs or investors also have put a lot of faith and confidence on the commercial real estate, and that is the reason why it is attracting a larger chunk of PE. So per se, we can't say commercial real estate is not doing well and not going to do well, but it is looking for a disciplined players, if at all, if I can use that particular word, or it is looking for more skin in the game. Like banks also earlier used to have only some amount of coverage, and now they wanted to go for the next level, Basel norms and all other things. Even the developers also have to put larger money or little lot more money than earlier if they are prepared for it. Even commercial real estate also is going to do well in the coming days. That is what my feeling.
Sir, one more question. Probably Mr. Rao, you can attend. This is more towards consolidation happening within the industry. So Mr. Ankit Gupta is asking that can you please give some thoughts on the consolidation happening in the real estate sector, especially with the large and mid-sized organized players?
See, it has to be seen in the real estate has 3-4 facets. One, commercial office space, then the retail, then the residential, warehousing, likewise. Maybe to a certain extent, it is right with regard to the warehousing because it requires certain different expertise also. Earlier, at one point of time, every landowner associated with one or the other and started their warehousing, and probably that is shifting to a larger extent to a consolidation player. When it comes to the commercial real estate, in major cities, some portion to a larger portion is coming to consolidation position. But still, the lot more commercial real estate is in the hands of different people. And in the residential, it is not at all with the only few players. Probably, if at all, if we segment in this within this particular residential segment, let us say a 1 crore and above houses or 2 crores and above houses, probably their consolidation is happening to a larger extent, but we cannot give a general perspective stating that the entire entire real estate or one particular segment consolidation is happening in that particular thing, and everybody has their own what I can say room for growth within that particular sector, within that particular city. Especially even experiments which many larger players have made, to spread themselves into different cities repeatedly failed. Probably it may see the success in the future, I don't know, but real estate is a local place first. Within that particular local, some larger players may be consolidating for the big ticket items, but generality of stating that everything is getting consolidated, I don't buy that idea.
Got it. One more question, probably Mr. Ashish, you can try to attend this. This is coming from Amit, and he's talking about the licenses. Basically, if you talk about the office leasing, licenses are basically preferring shorter tenure, lock-in and everything. But on the other hand, so far as the term loans or the other NCD, the financing part is concerned, this is basically getting that the tenure is getting longer. So do you see any refinancing risk also posing a good challenge in this segment?
So the first part, yes, there's a lot more flexibility that is being desired by the occupants. And the second part, the fact that you are getting a longer tenure loan or longer tenure financing is, to my mind, a much better thing to happen to the developer than a much shorter tenure financing. In terms of the risk, as long as your product is meeting the requirements of a large enough catchment, even with the flexibility, let's go one step back. As long as the country is growing, as long as all these businesses are growing, and as long as they need office space, obviously they're not going to be 100% work from home, but there's going to be a lot more flexibility. So as long as your macro factors are growing, the office demand will continue. And as long as there is demand, irrespective of flexibility, they will have to go somewhere, right? I mean, even if they vacate your place, they'll go somewhere else and somebody else will come to your place and so on and so forth. So yes, it's a higher risk from a short-term perspective. It's not a refinancing risk. I would call it a releasing risk, or, that would probably be a better way to put it.
Okay, got it.
Enough, let's say, liquidity or support to sustain during the period in between the two licensees, so to speak.
So we still have so many questions. Some of them are pertaining to Ahmedabad micro market, but probably in the presentation we are not covering it, so we will be dealing it separately. Some more questions are also pertaining to the warehousing segments, which also we have not covered, but we'll be dealing with the participants' request separately. So broadly, I think in and all, the time is getting completed. So let us come to the end of this particular discussion. So I think we have had a very interesting session, and more importantly, we have got clear answers from our experts. So all in all, we believe the real estate sector is definitely in a growth trajectory, and the collaborative effort from all the stakeholders would be definitely crucial in order for the sustainable growth. So thanks a lot for participating, and we'll be back with more such interesting sessions in the coming days. So please do join us, participants. Thanks again. Goodbye.
Thank you very much for having us.
Thank you. And thank you very much for having us here. Thank you.